We talked a little bit about the skills story. So the idea was going to be that for younger Canadians who are voting, there would be something on the housing side. We definitely saw that. We did see some developments on this for Canadian seniors, which we haven't talked as much about, but one example of that would be $1.8 billion over 4 years to enhance the guaranteed income supplement for low-income seniors. And then everybody in the middle who is wondering about whether a robot's going to take their job, which is starting to be a serious conversation that people are having right now, and they have to think about, well, can I make a transition in my work life? What is that going to cost me? The government essentially putting $4.5 billion to work over 5 years to help Canadians to get the skills they need for that. And as part of that, being able to make the transition, not just getting the skills, but that process of, being able to set some money aside and start to go through that overall process, Nicole.
Yeah, this is fantastic. I've been saying this is a huge issue. So on one side, we have this wild war for talent, for engineers, for people who understand technology, trying to get people to come from all over the world, especially the U.S., to work in Canada. And then we have another issue, which is AI and all of these things are changing the way that we're working. They're changing the demands we have. They're changing the job descriptions as we seek out people on our teams. And there's a massive gap. We're educating the majority of our millennials with Bachelor of Arts degrees, and we're actually looking for people with these very specific skills. So not only do we have a gap with young people, we have a gap sort of throughout the job market. And then I see, running a tech company, I go into our clients' offices, and there's a gap there. And so you have people in these large corporations, large organizations, the government, they don't know how to use technology. They don't know how to leverage all of these things that should be Canada's competitive advantage. We're having a moment now, I think, that it should be our competitive advantage, but there is absolutely a skills gap. So this is something that I've been happy that the government is taking on, and they're taking it seriously. How it gets done is the next question. Just $250 a year in credit, is that going to solve the problem? I don't know. I think it's a cultural shift. We're very comfortable here. It's a complex thing to evolve your skills. So, but is it something that we need? I believe it is.
All right. And something else we haven't really talked about is pharmacare. Obviously, heading into this budget, we knew that there was a priority on being able to tackle that next part of the process of getting treatment, which is that you generally need a pretty good drug plan to avoid some of those out-of-pocket costs. And so they're essentially, Sean, taking the next step with that. They had already set aside this team that was recommending setting things up. And so we thought there might be some startup costs associated. I remember before we got the actual budget details, you said, how much could they say without actually putting money to work so that it's something that can be discussed on the campaign trail? Essentially, they're introducing what they believe are the first steps towards the National Pharmacare Program, this new Canadian drug agency to coordinate the purchase of prescription drugs. But I guess, when it comes to the actual cost of this, that's a longer-term story.
That's right. Former Ontario Health Minister Eric Hoskins is leading an exercise to recommend to the government on next steps on pharmacare. His final report is due in June, so I think the language here is a bit of a down payment on an eventual pharmacare commitment, which may form a key part of the Liberal Party's election platform in October. I would just say the Parliamentary Budget Office estimates that a national pharmacare scheme run by Ottawa could represent as much as a $20 billion annual expenditure. And so while the dollars are excluded from today's budget, make no mistake, it will represent a significant fiscal cost for the federal government should we move in that direction.
So if we can just step away for a second and get to some of the realities about the Canadian economy, Francis Donald, we talked about how coming into this federal budget, we had seen roughly, call it 1.8% growth for the Canadian economy last year, which was a significant slowdown from 2017. As part of this budget, we have fresh forecasts from the federal government on what the economic story is going to look like. Looks like this budget is assuming economic growth of 1.8% for this year, so pretty in line with 2018, 1.6% in 2020, and 1.7% in 2021. That, to me, paints a picture of an economy that, even with all this spending that has been unveiled today and maybe getting some younger Canadians into the housing market, will have its challenges over the next couple of years.
Well, we better hope those forecasts are right, because if they miss to the downside, that means you don't get the revenues that come through, your deficit blows out, and your net debt to GDP ratio looks worse on both accounts. So we're in an environment where there's a lot of asymmetric risk here with the Canadian economy, and as a result, that means there's asymmetric risk when it comes to the deficit as well. It sounds sounds like they're being somewhat realistic. A 1.6% GDP for 2020 is about what consensus is looking for, but you could very easily see a very brief recession within a 1.6% GDP number next year, and that still fall into these forecasts. We need to be very careful that we're in an environment where we're close to the end of the cycle. A recession is going to come in the next several years, maybe next year, maybe the one after that, and we need to be careful that there could be big misses when it comes to these forecasts, and a lot of these forecasts when it comes to the deficit and net GDP much more than 2 or 3 years ago. We should have much wider confidence intervals on this budget relative to last year's.
And on this idea of our debt to GDP ratio, Sean, Speer, and we talked about these numbers off the top, but I'll reiterate them. The government is expecting that our debt to GDP as a percentage will come down from around 30.7% for 2019-2020 to around 28.6% by 2023-2024. Since we are running some sizable deficits, the finance minister has really shifted the focus to how much debt we have as a percentage of GDP and how that would compare to, the UK, for example, which I think runs a lot closer to 70%. Is that a good estimate of the health of the Canadian economy, number one? And number two, the kind of spending that we're seeing in this new budget?
Well, I'm not sure if it's a good measure of the Canadian economy, but as Francis says, it certainly reaffirms Canada's relative fiscal health. The one thing that we haven't talked about is last year, for the first year in a long time, debt interest payments climbed. And so I'll be looking to see whether debt interest payments are moving in the wrong direction. And then the matter of downside risk. We're running structural deficits at the top, near the top of the business cycle. And the outcome of the next election, of course, is still unclear. It seems to me either today or in last year's budget, there should have been a greater emphasis placed on based on fiscal caution. We haven't seen that. And so we find ourselves facing a kind of fiscal risk that we haven't seen for some time. And ultimately, I think, as I said earlier, it'll be up to Mr. Morneau to argue why the choices they've made are justified. But with a lot of spending pressure coming down the pike, including a possible major commitment on pharmacare and the economic uncertainty that Francis outlined, it seems to me there's reason to think the risk is on the downside to the fiscal numbers that Mr. Morneau has released today.
And I'll point out there's no mention of a return to balanced budgets in this. In this federal budget. Probably no surprise there, Nicole Verkent. But, as we listen to all of this, you as a business owner making decisions on spending, what's going through your mind right now?
Something's going through my stomach. It's kind of churning. I mean, I'm seeing red on your screen as well. To me, that's what it comes down to. It comes down to confidence. And I think when people are feeling confident, they start spending, the angel investors start investing in startups, general business investment starts to flow. Maybe we build some houses, we get some warehouse permits approved, et cetera. But as soon as we start to hear there's maybe some dark, stormy clouds coming up, everyone starts to retract. And as a smaller business owner, you start to see the impact with your clients, with the bank, with maybe not with angel, with all these different people. They're starting to see it as riskier investments, smaller businesses, entrepreneurial, innovative things. And so to me, it comes down to the sentiment of confidence and whether or not that's here right now. And I think with the spending spree that we're seeing, it's reducing a bit of confidence, especially towards some of these higher risk areas of the economy, which is the innovation economy. So that's my concern.
Even
is what's
though
to come.
They would be trying to, I'm just going back to those tax changes. It gets to be a little inside baseball, but I know it matters to a lot of our viewers, the idea that they would cap employee stock option deductions for high income individuals, or it'll be a lot of people talking about that, certainly, but that they would leave the deductions for startups and rapidly growing companies unchanged.
But those individuals are our investors. Those are the people that, when they have that capital, they're investing in our economy, or they're investing to build. So that's all part of the same machine, and it's all connected. And I think we can't ignore that if we're punishing those individuals and we're not incentivizing them, then the rest of the economy will suffer. And they surveyed the CEOs of the BCC, Business Council of Canada, and the confidence level in terms of the future of was the lowest it's been since they started the survey, 15 years ago or something. And that's, to me, I know economists don't like talking about feelings, but to me, that's a bad sign when you're starting to feel that things could be getting stormy and there's no money under the mattress.
I love talking about feelings.
Well, I don't.
Particularly CEO feelings. So if you look in the United States, for example, 82% of CFOs feel that there'll be a recession in the next 2 years in the U.S. Now, we don't have a similar survey in Canada, but I can expect that it's probably similar. So if you're sitting at a C-suite table and you're looking for large-scale fixed investment or hiring, you're probably not
buying
going
software.
you're probably not going to see that activity if everyone is worried about a downturn. So there was an opportunity here to say, don't worry, be happy. We will support this economy through this rough patch if we do hit it. I'm not sure that what's in here is enough to make people feel like they can smooth out a recession path if we do hit one.
I do want to just go back to what we were talking about with Nicole before. The Council of Canadian Innovators has put out their reaction statement just on that issue of stock options. They say high growth companies use employee stock options to attract the best and brightest talent to work at their companies, especially when they can't afford the salaries Silicon Valley giants do offer. Our members are concerned by the government's intent to change the way employee stock options are taxed, but are hopeful the government will work with Canadian innovators to avoid some of those unintended consequences. I guess if we're going to talk about unintended consequences, choosing this path for Sean Speer, for the Liberal government in this election year, what could work? What might not work? What might be some of the unforeseen consequences? The same way that we didn't know what was going to happen as soon as the government got involved in the housing market in the first place.
It's a great question. I mentioned earlier that this budget will embed for the first time the carbon tax revenues as the new federal carbon tax comes online next month. I've said in the past, John, that I think we're walking backwards into a national election in October that it may be a single issue election around the carbon tax. Mr. Trudeau and his team seem to be leaning in to the political case for carbon taxation. I think it's something that they think motivates progressive voters. And Mr. Scheer and his party are certainly leaning in to their opposition to a carbon tax. And so I think it means we may have a substantive policy debate that animates the election, and a clarifying one about Canadian climate policy. If Mr. Trudeau and his government are able to win re-election championing a carbon tax, I think it would codify carbon taxation as an ongoing part of the Canadian climate policy agenda, and the opposite is true should Mr. Scheer win. And so today's budget may be the starting point for this protracted debate about carbon taxation that I think, as I said, may very well animate the October election campaign. And embedding the revenue figures and the plan to recycle those revenues makes that debate real.
Well, and we had seen the small business lobby ahead of this federal budget try to make the case, pointing to, I think, 4 provinces, they had said, where they felt that small businesses wouldn't be able to pass on more than a quarter of the carbon tax cost. So it is certainly something that will continue to be debated.